Here we have the 30-minute price chart for Marathon Digital Holdings Incorporated, stock ticker MARA. Here we can see that the stock has been trading under a fair amount of pressure ever since the stock posted its recent highs near $27.30. This high would have been posted on the July 17th trading session. So we have seen a fair amount of upside here. Even with the fact that, even despite the fact that, there's been a much broader sell-off in the market as a whole. But since then, we have started to see some fairly significant declines here more recently. If we're looking at this upper price zone as the basis for our Fibonacci retracement study, we can look at this high, which posted at 2730, and then bring down the lows all the way down here to the July 10 low, which came in at 1879. So if we're using this as our current dominant price move, we can see that we have already broken some fairly significant Fibonacci levels in the process. Fairly quickly, we did break through the 23.6% Fibonacci retracement, which came in at 25.27. This coincided fairly well with the 20-period exponential moving average, which is the yellow line here. So we did see a bit of a confluence here, but there was a fair amount of selling pressure, and we did break through this level quite quickly. As this happened, prices formed a new lower high in the process, and then this was followed by another lower low. This lower low is significant because, as we can see here, we did break through this orange zone here, which is the 38.2% Fibonacci retracement, as well as this rising 50-period exponential moving average on the 30-minute chart. So this was a confluence of technical indicators appearing in the same area, roughly the same area. And this does suggest that a fair amount of downside selling pressure is existing in the market, because we did need quite a forceful move here to force prices through these levels. As this happened, we can see here that a downtrend parallel price channel was formed. And this does leave us in a position where we have now seen a series of lower lows that occurred three consecutive times. So we've got this first low here, July 17. This following low came the following day on July 18. And then this final low posting here was roughly during the closing portion of the July 18th trading day. Overall, you can really look at this pattern in a few different ways. I mean, you can look at this downtrend channel as a downside parallel channel, but at the same time, what you really got here is a bull flag pattern. This is a fairly significant bullish price pattern because, if we do confirm the pattern and break to the top side, the upside target becomes fairly significant. It's essentially equal to the flagpole itself, and this would be considered to be the flagpole, this kind of white line here, and then this parallel channel, which is facing downward. So that makes it maybe a little bit difficult to understand. But what you're really looking at here is a period of retracement after a long trending move to the top side. So it would need to it would need to face in the downward direction. But as long as we see an upside break here, it would confirm the pattern. The problem here is that we do appear to be kind of forcing prices into the downside. It's not totally clear that we're going to be able to break out to the top side. And then if that does occur, this would invalidate the pattern. This pattern would no longer be valid. So to the downside, we have to kind of look at some areas which might be viewed as potential support zones, because there are a few here that are looking fairly obvious in terms of potential buying areas. The first zone that I would point to would be the 50% Fibonacci retracement, which is kind of this darker green line here. This comes in at 2301. And then at the same time, we've got this rising 100-period exponential moving average, the purple line here, which is the 100-period exponential moving average. So as we can see here, we are seeing a confluence of indicators once again. I mean, this has happened roughly three times here. I mean, because I'm going to be pointing to this blue line as well. But here we can see that, we've got this orange line, crossing into the orange zone. That's just a coincidence. These don't have any real connection to each other. The color, both being orange, is not significant, but they do cross into the same region here. And then this purple line here is crossing into this green region here. There's a confluence of indicators here. So to the downside, I would point to this $23 area as my first sort of downside support target. This does look fairly decent for possibly entering into long positions here. I mean, I'd like to see a bit of a bounce out of this area before buying, because we do have a fair amount of downside momentum here, and there is a slightly bearish condition in the relative strength index. But with all of that said, we are rapidly approaching oversold territory here. So a bounce could be coming fairly soon, and it would not be surprising to see it at one of these levels. So the first level that I'm really pointing to here does come in at $23, roughly even, pretty close to there. And then below there, we can also look at the $22 level, $22 even. It's just kind of a coincidence that these are matching up that way in a $1 increment at roughly even numbers. Usually doesn't happen like that. But here we're saying that these are, roughly 23 even, and then roughly 22 even. So, if you wanted to possibly structure a position here, it would be possible to say, maybe enter into half of the position if we do see a bounce out of this 23 area. And if we start to see prices move higher, we could sort of draw an arrow here to kind of make that clear. Or, if ultimately we did see another downside failure of this area, we could possibly enter into the other half of the position on the approach toward 22. The reason that I'm pointing to this area is because it's the 618 Fibonacci retracement, which is arguably the most important Fibonacci retracement level. And then at the same time, you've really got this 200 period exponential moving average that's sort of quickly sloping into this area. So as long as you see this confluence match up here in both of these levels, these can both work as viable entry points for long positions. Currently I would probably scale into this trade. I wouldn't go all in with a single position here. I'd probably do 50% at 23 and then maybe another 50% at 22. Probably best to scale in this way. You could even do thirds if you wanted. I mean, if you really wanted to scale into a third of a position at 23, a third of the position at 22, the next third of the position would probably go in at roughly 2050, which is the 78.6% retracement, and then possibly you could stop out, say, on a break below the $20 level, something along those lines. So there are a couple of different trade ideas here that can be considered viable. We are going to start to need to see a bounce out of these areas relatively soon. But given the fact that the relative strength index is sort of heading into oversold territory here, we might be seeing this happen relatively soon. So here's the current market analysis for Marathon Digital Holdings Incorporated, stock ticker MARA.